Okay, hello. Today I'm going to give my case for Tilray brands. And before we get started, this is not investment advice. I talk with your registered investment advisor. Don't take this as, investment advice, all the legal disclaimers. Past results are not indicative of future results. There are many opinion statements in this. This is my own opinion, and I am not working on behalf of you. So do your own research, and this is more of just an opinion piece on why I personally have bought Tilray brand stock. I have bought Tilray brand stock. I currently own 350 shares plus another 8 long expiry options contracts, which I'm using just to kind of use in lieu of stock. Very long expiry with what I believe is reasonable break-even prices, which I actually already have broken even on them, so I just plan to hold until basically the end of their expiry. Anyway, I'm telling you why my reasoning for buying it. Let's get into it. They just released their annual report, their 10K, just 2 days ago. And there's been some big moves on it. It's dropped very quickly. The big thing is the dropping price. So, Tilray over the past 5 years has really just gone down in price, and people have not been liking it. I say it's on a discount. I say that it's on a very big discount right now. The big reason why it dropped this time was we're seeing a massive impairment charge. A massive impairment charge onto their assets, their intangible assets, and their goodwill. And that is more or less what people are talking about. It's that, and it's just operating expenses in general, which their total operating expenses were $2.5 billion, which is a far cry from their $0.4 billion of last year. I'm here to say I don't really care. I think that's okay, and in fact they're moving in the right direction. That's my opinion. So let's go into kind of why. We'll go into deeper on like the actual books and everything, but let's look at this exact impairment charge right now. And if we go into here, this is like a breakdown of the operating expenses, and really everything is not so bad. There are a few things here and there, but the big one by far is the impairment. This $2.0 billion. And that is primarily from the brands. So they overpaid for a lot of brands. This is list of some of their brands right here. They've got tons of them, and this is a full list of their brands. So a little bit of history with them is that they are a cannabis producer and distributor, and they in 2021 went into the craft beer market by purchasing I think it was 11 brands from Anheuser-Busch, as well as 1 or 2 others, and then they went into they doubled down and bought even more from Molson Coors in 2023. These are noted as Craft 1 and Craft 2, Craft Acquisition 1, Craft Acquisition 2. I can't find them right off the top right here. Here we go. full period results from the Craft Acquisition 1, which was completed in 2023, and recent Craft Acquisition 2, which is effective 2024. Right? So what they've done is they've essentially bought a whole bunch of these brands from Anheuser-Busch and Coors, and they have to, some of them are not worth that much. And that's kind of expected, you know, when you buy in bulk from one of these big companies that are trying to sell it. But really, when you take a look at each of their, you know, sections, they operate in 4 different sections. They operate in beverages now. They operate in cannabis, which they've done traditionally. They're the first cannabis company to IPO and be traded on the public market. And they've got their distribution business and their wellness business. Now, a lot of people are saying that they're a cannabis company and that they're entering the beverage market. And that's just, in my opinion, not what they are. And I don't think that they are really trying to be that, and I don't think it's smart for them to be that. What they are is a distribution company for cannabis and beverage products, because in fact that is where their largest part of their business is coming from. 33% of their total revenue is in distribution, which is fantastic. That I can't really overstate how hard it is to find distribution and how that is often the bottleneck in these adult product markets, is finding a solid distribution line. And what they've done is they've brought it all in-house, and they actually have a fantastic distribution line for their beverages currently. So they're in a ton of airports. They have strongholds in all throughout the North America and the Pacific Northwest, Southwest, Southeast, and Northeast. And that they are really structuring and integrating these distribution markets into their product businesses. So not only in North America, but they are operating in international markets as well, and they've got a very strong presence in international markets, and they're one of the first cannabis companies in many of these countries, including Germany, UK, Italy, Poland, Netherlands, Czech Republic, Greece, Portugal, Austria, Switzerland, Denmark, Croatia, Malta, Luxembourg, Ukraine, and Ireland, including North America. And they are currently undergoing, this is what I'm focused on right now, is that they are undergoing Project 420, actually, as a part of a restructuring plan, basically. And so this is, for me, the main thing that I'm trying to help them out with, because it's a very clear vision and it's very strong. And so what this is strengthening their distribution line and their product offerings for primarily their beverage business, but integrating into the greater brand and whole. And a lot of that is SKU rationalization, right? So getting rid of products. They just bought all these, bought 20 brands of beer from some of the largest beer brands in the world, and not all of them are worth having. And so they've been really focused on SKU rationalization, which I think is what is leading to the impairment charge, right? Is because they're looking at it and they're saying, okay, we don't need some of these shitty brands. We shouldn't focus on them. We overpaid for them. We have to write them as an impairment, legally. So they are. And they're also focusing on geographies, where things are really focused, like Sweetwater in Georgia, and with 10 Barrel in Oregon, and, really focusing their geographies in their distribution rationalization. They work with some other distributors, but they're really kind of trying to bring that all in to their own distribution lines. and reducing their distribution footprint from 750 to 450, which is, awesome too. In addition to this, they're just trying to optimize their whole processes. This is all part of it, which they are focused on trying to achieve 25 million by 2027. Where is it? Somewhere over here. Whatever. You're trying to achieve 25 millions of savings by end of Q4 2026. Here it is. By Q3 2026, apologies, they're trying to achieve $25 million in savings, and already by focusing in on this optimization plan, they've achieved 24.1 million of those savings today, which is fantastic. Once again, with the Project 420, they're trying to reinvest in their brand and business and having everything kind of be established as one cohesive brand, Tilray. And part of that is getting rid of the companies and properties that don't fit that brand. So I think this is very strong, and I'm very for this Project 420. That being said, when we look at their actual books, their net revenue's going up. Cost of goods sold is, steady, but that is happening with restructuring. Things get expensive temporarily, but all in all, the books look pretty good. And then if you look at the revenue, every single segment is going up in revenue with the exception of cannabis revenue. And part of that is the international market. So part of the risk that I'll go into as well is that things in international markets, permits for medical cannabis and things like that, is happening to be slower than previously expected. It seems like a large push for medical cannabis happened in the 2010s to 2020, and now things are kind of reeling back a little bit, but things be slow. It's a risky market, but all in all, costs are going down for the most part. Things are good. And here's a breakdown of each of their individual lines of business, and you can see, revenue is really doing well. Cannabis going down a little bit, but once again, I don't really give a shit. All I'm really focused on, or one of the things that I'm really focused on, is this distribution, because this is where they make most of their money. They don't have the highest margins, but even for cannabis, their margins are increasing significantly, and that's good. I'd rather see that than an increase in net revenue and a decrease in margin for their long-standing business. While their beverage business gross margin is going down, but that's also because they've got that whole restructuring plan and the SKU rationalization, so it makes total sense. I think that here we go, we've got an update from them on the international markets, just the legalization processes and the updates on permits. Something that wasn't included in here was that they were the first people to be approved for medical cannabis in Italy in late June. So that was really cool. But things are just moving slower, right? That's it. That's not really new. And not only that, but so just in terms of their actual forefront in their structuring and running the business, I think that they're going really well. You can see that administrative costs are incredibly consistent, right? And they have just undergone two major, major brand acquisitions and entering a new line of business. And that is primarily where the increase in salaries is coming from. They mentioned that down here, primarily due to the inclusion of employees from Craft Acquisition 2. Sorry, let me scroll down so you can see that. The change was primarily due to the inclusion of employees from Craft Acquisition 2. But it's not that much, and they're reducing costs in a lot of other things, just professional fees, their gain on capital assets is turned over, things are good. And even their books reflect that. And I think that is also one of the main things that draws me to Tilray, is their reporting quality. They're really conservative in their reporting, and they've got really high, in my opinion, maybe not the highest, but they've got significantly high reporting quality, and it doesn't seem like they're trying to sweep anything under the rug. We can go through this, they've got great books, and they've got a fantastic treasury to draw cash from, and they aren't really hurting for, they aren't worried about insolvency. They in fact just paid off a lot of their debt. Their long-term debt has been steadily decreasing, and their liabilities are going down. Things are pretty decent, to be honest, and I think that in terms of just actual reporting quality, they're very straightforward and conservative, even with the impairment. You've got very, they're expecting a terminal growth rate of 2%. That's nothing, and that's expecting nothing. They've got quite high discount rates in their calculations, and they're calculating the impairment value to these brands, but in reality, I'd be willing to bet that it's not as bad as that. So, I'm excited for the future. Let me put it that way, because it seems like, based on their calculations, they really wanted to be on reporting the higher end of losses rather than trying to downplay. And I like that a lot. And I think that the company does that themselves. I think they've got a lot of trust in themselves. You can see the CEO just yesterday purchased another 165,000 shares, while the CFO just yesterday also purchased 33,500 of their shares, and that is not uncommon. This is when they did it, just 2 days yesterday. And then just last month, they purchased some more, and then even some other of their directors purchased some, and they've got a history of buying. Hardly any of them sell any of their shares, and really, I think that speaks just a lot to the company and their trustworthiness, and I think that they're doing the right things. That being said, they're involved in a lot. So they've got, 4 lines of business in primarily volatile industries and operating all over the world. So when they're doing restructuring, they've got a lot of moving parts, and they've got focuses on a lot of different things. You can even see that some of their brands are research companies, right? Some of their Tilray Medical is research, and so there's a lot of different moving parts, and I don't like that for them. I want them to be focused a little bit more, but I understand the need for this time to just kind of have everything covered. But that is still a risk to me. That even though that they're trustworthy, and on top of it, they've got a lot of moving parts, and in addition to that, that comes with a lot of different things, not just making sure the right thing gets done, but critical accounting policy changes, right? Because as you enter different businesses and have, different acquisitions and have to impair those acquisitions, your accounting policies change, and that is another risk as well. So I think that, in my opinion, is their biggest risk at the moment, is just their exposure to so many different lines of business. But that's also why I want them to focus on their distribution, which they seem to be doing quite a bit, you know, as much as they can. Maybe they could do more, I don't know, but that's why I like them, is their distribution. Not only that, though, they also have some ongoing litigation from some previous acquisitions, primarily with Afria, and that's ongoing. You kind of are going to have to see that with, you know, most companies, right, is some sort of litigation and ongoing legal battles. But, you know, so they even had a partner go out of business as well. Some of their investments, the company went out of business, and they've completely like severed ties now. So that had an effect on the earnings as well. So their investments were down. Yeah. And so not only that, but then also they're doing some risky / you know, newfangled treasury management, and they're including some Bitcoin and cryptocurrencies in their treasury management, which is exciting but also risky, and once again I think kind of falls into that whole spreading too thin. Now, I don't think that they are spreading themselves thin, and I think that their baseline businesses are doing great. And I think that a lot of the talking points for why this could be a sketchy buy aren't going in depth on why those are not actually sketchy, because they're talking about impairment and operating expenses, and it's very clear that those operating expenses are being used to structure and re-strengthen the company as a whole. So for those reasons, I think Tilray is an excellent buy right now, and I personally own any. These are my own opinion. This is not legal or financial advice, so, you know, do your own research, read the earnings, but I think it's a fantastic time to buy. It's on a massive discount. I don't think Tilray's going anywhere. I think that we're gonna see Tilray become like the Anheuser-Busch of the next generation. You know, I think that they're around to stay. I think that their Project 420 is a wonderful restructuring initiative that they got going on, and I think that they're doing the right things to ensure an effective execution of that strategy. So I'm excited to be partnered with Tilray. I don't know why this isn't loading. I'm excited to be partnered with Tilray for the coming future, and I'm gonna be with them at least through Project 420. So that's my thoughts. Those are the reasons why I think Tilray is a good buy. I think, son of a bitch, fuck this. Anyway, I hope this was informative and fun, or, you know, I don't know. I don't even know why I'm doing this. But thanks for watching. Bye-bye.